Nubank stock has fallen 39% from all-time highs. However, I think at this point in time, nobody should be surprised because I believe most of our portfolios are down. And the real question is whether or not we can actually find positions that are worth doubling down on during this time of volatility. And more specifically in this video, we're going to answer the question whether or not Nubank makes a better buy than SOFI. So Nubank is basically a neobank founded back in May of 2013 by their current CEO, David Velez. Now, Nubank currently serves over 100 million members on their platform, and the members come from 3 countries, mainly Brazil, Mexico, as well as Colombia. Now, in Brazil, 1 in every 2 adults is actually a Nubank member, and on top of that, they have actually also allowed 20 million Brazilians, or nearly 10% of the entire population, to get access to their first credit card in over 5 years. So to me, I think what's impressive about this platform is not just the sheer number of members that they have on the platform, but how engaged these members are, because the activity rate of these members is above 83% on a monthly basis. Now, if you're talking about Nubank's ambition in the years ahead, they have ambitions to expand beyond Latin America, and they have made moves to enter the South African market as well as the Philippines market. So they seem to really be growing at a much faster pace than companies like SOFI. So do they really have the potential to become one of the largest fintechs in the world, or is this all overblown and the recent sell-off is actually warranted? But as always, potential is a dangerous word, so let's dive in. Now, I'm going to be approaching this video slightly differently from before when it comes to building out the thesis of an entire new company. Now, if you are not aware, this is actually the second video in a series where I'm basically deep diving into companies that you have actually asked me to in a previous live stream. So if you haven't caught the first video in this series where I talk about this one company over here, I'm going to link it up above. But when it comes to Nubank, I'm definitely still going to be talking about what the company does, all the different revenue drivers, but I'm only going to be covering it at a high level because I do believe that while their business model is nothing out of the ordinary, I really want to focus on what is their secret sauce that makes them different from the other fintech players. But a quick update, the reason why there hasn't been a live stream recently is because both of my dummy batteries died and I have to rely on the normal battery which can't last through the entire stream. So I really do need to get them replaced soon. But back to Nubank, I think what we really want to focus on is how they actually drive unit economics and efficiency within what is, considered a typical fintech business model, and explore why the stock is actually down 39% from all-time highs over the last couple of months, and whether or not the fears around this company is actually overblown. You see, Nubank's mission is quite simple. It's actually to remove complexity and empower people in their daily lives by providing accessible, affordable, and easy to use financial products. And over time, as you hear their CEO David Velez speak about the company, I think you realize the key driver, or what drives the whole company forward, is actually found in the words remove complexity. You see, every time I listen to him talk about the financial services space and the size of the market, in front of them, which he actually calls a $7 trillion profit market. He's not talking about revenue, but $7 trillion profit market. I get excited about the opportunity in front of Nubank. Now, David Velez really is a mission-driven CEO. I think back in 2021 or 2022, he actually gave up his stock-based compensation package. Now, and this is basically just to save Nubank over around $356 million over the span of the next couple of years. And this was done during a difficult position or during a difficult period where he protected shareholders against share dilution. So to me, this focus on efficiency really echoes throughout the entire company, and this is what we want to focus on moving forward. So if you take a look with me at Nubank's business model over here, like I said, it's nothing out of the ordinary. The types of products and services that they offer to their members is something that you would expect of a typical fintech, right? So they do have a digital banking platform that they offer to their members, and they offer both personal and business accounts on their platform, right? On top of that, they allow members to spend with their credit and debit cards, nothing out of the norm over here, as well as what you can see over here, Pix acquiring. When I did a little bit of reading, this is basically a real-time payment system developed and operated by the Central Bank of Brazil, and this basically enables customers to pay businesses as well as enabling instant 24/7 transfers. So on top of all of this, they also allow their customers to invest on their investing platform, and they also provide insurance solutions. Now, I believe some of this is done by some of their partners, but they basically allow their member base to also build a credit history and get access to both secured and unsecured loans. So David Velez basically, in his own words, tell us that their business model is simple. They acquire customer at low cost and engage the customers on their platform to use more products, and because of that actually generates revenue for the company. It's a very simple to understand business model. But I think what I really want to focus on is the moat that this company have, because you can actually see that their moat is defined by their vision in the words reduce complexity, because they are able to reduce complexity for the Brazilian population and for the people in Mexico and Colombia, that they become more engaged in the financial sector, and because of that, they're actually engaging more and more on their platform, generating more and more revenue for Nubank. And we can see that they're able to grow their customer base organically, and what that means is that a lot of the new customers that come onto the platform actually find out about them and come onto the platform either through word of mouth, through word of mouth, either that or through unpaid referrals from existing customers. And so how this is actually translated into tangible metrics that tell us the story is what you can see over here. They are able to maintain a low customer acquisition cost that has an extremely short payback period. So now if you take a look at this graph over here, what you're going to see is that this first graph basically plots the customer acquisition cost and compares that with the revenue generated per member on a quarterly basis. So the green bars over here basically represent the cost to acquire a customer each and every quarter, and the purple line represents the revenue generated by that particular member that is acquired in that quarter itself. So what this tells you is that within the same quarter, they actually make back the entire customer acquisition cost and actually earn more than that per customer. Now, this is actually more clear in this second graph over here. You can see the purple bars basically represent the customer acquisition cost, and the green line on top of that represents the payback period. So if you take a look on the axis, on this, the right axis over here, you can see in some quarters, especially in the third and fourth quarter, which is where you actually notice that there's a bit of cyclicality in terms of the way that their marketing cost goes. So during the third and fourth quarter, where marketing costs tend to go up, even then the payback period is still less than a quarter, which means that they actually make back the entire marketing spend within 2 to 3 months. So if you consider, other banks and other companies like SOFI, SOFI currently has a customer acquisition cost of anywhere between $280 to $300 per member, and each member generates around $70 of revenue for SOFI. Now, what that means is that it takes SOFI around an entire year in order for them to break even on their customer acquisition cost on a new member. And so whereas in Nubank's term, they're actually breaking even in the quarter itself and starting to make profit in the quarter itself. However, it doesn't end there, because after acquiring the member onto the platform, as the member uses all your other products and services, it takes cost to serve that particular member, and this cost to serve each member is actually very low on Nubank's end as well. But before we get into that, I just want to put some context into this whole idea of customer acquisition cost and the payback period. You have to understand that when I'm talking about SOFI's customer acquisition cost in comparison to Nubank, it's not an apples to apples comparison, largely because they operate in vastly different markets, and so they're exposed to different type of clientele, and they're exposed to different kind of risk factors. So SOFI tends to work in the higher credit range, going after the more mass affluent kind of customers, and so because of that, naturally they have a higher quality of members compared to Nubank. And of course, in terms of Nubank, the demographic that they're working in just means that there are higher risk factors in terms of default rates. But Nubank, what you really have is a business that has proven over time that they can serve this customer and serve them in a very profitable manner. So if you just drill a little bit deeper and look at, beyond the cost to acquire a customer, the cost to actually serve the customer each and every month that they are on board Nubank's platform, what you notice over here is that the cost to serve per customer per month stands at around 80 cents. Now, while they're spending 80 cents to serve the customer on their platform, this customer actually generates them $10 per month in revenue. So I think, yes, we have to acknowledge the risk factors and things like that, but whatever country this bank is in, I think when you spend 80 cents to serve a customer and the customer makes you $10, I think it makes a really good investment. Now, to me, I think the really scary part, or maybe the most impressive part about this whole thing, is in this podcast over here, where their CEO, David Velez, basically said that in a typical bank in Brazil operates at around a high $30 to $40 range of revenue generated per member. Now, a large reason for this high revenue per member generated by all these legacy banking institutions in Brazil is because of all the hidden fees that are, wrapped into all the different products that their members are using. Oh my goodness, my English today. But in Nubank's case, because they actually keep the fees to a minimum and there are no hidden fees at all, because of that, he actually says that it's quite unlikely that we will reach $40 of revenue per customer, and he expects them to top out in the $25 to $30 range. Now, on the surface, that seems actually like not a good thing, right? If other banks are actually having revenue per customer of $40 and you're only operating at $25 to $30 range. But I think their real edge, Nubank's real edge, is their ability to keep the costs low. It doesn't matter if they don't reach $40 per customer, as long as their cost to serve each and every customer is still maintained around the $1 range. I think when you combine both of these things together, the low customer acquisition cost as well as the low monthly cost to serve each customer on your platform, this forms a really strong moat for the company that underpins their whole proven business model. And I think what this means is that they have become really, really strategic. They know who their business model serves and in what kind of environment does this business model really becomes profitable for them. And so because of that, they have been really strategic in where they choose to expand. So when they have chosen to, when they told us that they chose to expand in countries like South Africa and Philippines, that got me really, really excited because it really fits that demographic, a large part of the population who are unbanked and underbanked, and people who are looking to move away from their legacy banking systems. And so when they place themselves in this environment with such a proven business model, we can expect same type of results and same type of unit economics. So like I said, as long as they continue to expand in these type of markets where the large majority of the population is underbanked and unbanked, then I do think that this superior unit economics compared to the legacy banking system will definitely work in their favor. And I think the one thing over here, or the one caveat over here, is whether or not when Nubank actually moves into more developed markets like Europe and in the US, whether or not they can actually replicate these type of numbers. I think to me that really remains to be seen, and I don't expect there to be the same kind of correlation in terms of the unit economics. But like the CEO was telling us, global expansion is only starting in the back half of 2025, and I do think expanding into South Africa and Philippines actually makes a very smart choice for them. Now, the only thing that I would say over here, or some of the concerns that I've heard about Nubank, is that will there be a time where there's going to be saturation in the market and their marketing spend will eventually go up to acquire every incremental new member? And I think if you think about it in the long run, in the 10-20 year span, of course, I think that is something to be expected. However, I don't think that's going to be a major problem in the next couple of years because they can, still increase their marketing spend by 4x and reach the same type of unit economics as SOFI. And David Velez basically already told us that currently, Nubank basically only makes up 3% of the entire financial services revenue in Latin America. So these are still really early days for the company. So yes, perhaps they may have to increase their marketing spend, but in terms of the ability to capture greater revenue in the financial services sector, they still have a long way to go as well. So I think it's hard to assign a qualitative value over here to the different markets that Nubank and SOFI are operating in, but the fact of the matter remains that both of these companies have a lower customer acquisition cost than the legacy banks, which means that they can scale at a pace that these other banks can't. And so because of that, the ability to move quickly is supported by a modern banking core where the legacy banks are severely lacking, and that is a moat for the companies. So what are some tangible metrics that we can actually see to confirm that this is actually happening, that these moat around the customer acquisition cost and as well as their low cost to serve is true? So how Nubank actually tells us that they measure the efficiency of their business is actually summarized by this very simple formula over here. They take the number of active customers on their platform, multiply that by the average revenue per active customer, which is, like we said, $10, and then subtracting away the cost to serve, which is hovering around 80 to 90 cents, and that basically represents the earnings power of Nubank. And so that really in turn tells us that, these are the metrics that are really important to the company, and that is what allows us investors to understand, how to measure the company going forward and to actually filter out all the noise. So if you actually take a look, like I was saying earlier, if you take a look at the business model itself, right, it doesn't seem like there's much different compared to some of the other fintechs as well, but where they're winning is really by having better unit economics. And you can see over here, right, they actually grown their member count from just under 40 million members in 2021 to around 110 million members on their platform by 2024. Now, during this period of time, what I think is really impressive is that this green line over here, right, usually the more members you get onto the platform, the less active members that you have, but both of these are actually growing in tandem. The more members they actually get onto the platform, the more active members they actually find on the platform. That is, like I said, I believe is down to their whole company's mission of reducing complexity. When complexity is reduced, people just interact more with the product. And so what that means is 8 in every 10 new members continue being an active user on the platform every single month. Now, the evidence of this is very clear in terms of the number of products used per active customer. Currently, this stands at around 4.1 product per member, which is quite impressive because on each and every cross-sell of a new product, that is incremental margins for the business without incurring any additional customer acquisition cost. So it's not just the revenue that is increasing. You can see in these two graphs over here, the deposits per member have also been increasing over time, as well as the loan originations per member, that has also been increasing over time. So all these things show that the banking sector of this whole business is actually growing in a very healthy rate. Now, like I was saying earlier, all of this really translates into a better unit economics for Nubank, right? Because it's not just the customer acquisition cost that is measuring how much it takes to acquire a new customer, but the cost to serve these customers each and every month that they are on Nubank's platform is basically pretty constant. And so you can see over here in this next graph, the average revenue per customer that has climbed up from just under $4 in the first quarter of 2021 to over $10, which is where we find it today in 2024. However, during this period of time, as they have more than doubled the revenue per customer, you can actually see that their cost to serve each and every customer has stayed at around 80 cents, and they plan to keep that below $1 for the foreseeable future. So if you're wondering why is there a decline in the average revenue per customer over here, I think that's largely due to their expansion in Mexico and Colombia. So when you expand into a new market, it takes a while to scale the business and for the newer members to interact with the platform. And as they adopt more and more products, we can see these revenue per member start to ramp up again, right? Reaching similar operating efficiencies. So in general, I think the key metrics are doing well for the company, and that is reflected in revenue growth. Now, despite the foreign exchange, the FX headwinds, revenue still grow 24% year over year in Q4 2024, and revenue per member is still above $25. And so this $25 per quarter, and this, like I said again, right, this drop that you can see over here is largely due to expanding in new geographies. Now, gross margins remain strong for the business, right? The gross profit has been increasing, and they have maintained their gross profit margin in the 40% range. Now, net income came in at around 90%, so that is fairly strong for the company as well. Now, however, there are still some things that I want to point out for us to pay attention to in terms of Nubank going forward. Now, if you take a look over here, net interest income came in at $1.7 billion. Now, this represents a 57% year-over-year growth, which is actually very strong, or a 9% quarter-over-quarter growth on an FX neutral basis. However, net interest margins actually contracted further this quarter. Again, for those of you who are slightly newer in trying to understand the fintech space, trying to understand the banking sector, what the net interest margin is basically helping you to find the difference between the amount of interest that you receive and the amount of interest that you have to pay out on customer deposits and things like that. So in Nubank's case, in the most recent quarter, they actually explained the reason for their lower net interest margin. So firstly, this actually reflects lower credit yields because they are shifting their product mix to include a larger share of secured loans versus unsecured loans. So to me, this is a trade-off that they're making. They're actually making their loan portfolio safer for a lower interest rate, right? So additionally, the customers that they have on their platform are building better credit profiles. And so because of that, they actually qualify for loans with lower rates. And I think this ultimately is what Nubank is hoping to do, allowing their customers to participate in the financial market by building up better credit profiles. So you can't really complain about that. Now, secondly, another reason for the contraction in net income margin has to do with an increase in funding costs into the new markets that they're expanding into, Mexico and Colombia. So as a result of stronger deposit growth in both Mexico and Colombia, what we're seeing over here is that because they're paying more interest on these customer deposits to attract new customers, and more new customers are actually coming onto the platform, then you can actually see why that actually contracts their net interest margin, right? Because like I said, interest received net of the interest that you have to pay out on customer deposits. But if you think about it in the long term, that isn't actually a bad thing for the longevity of the company. And after some time, all these customers will actually generate revenue for the company, and then you can actually see this net interest margin improve and increase again. So of course, some of these contractions are also down to FX movement that negatively affected their net interest margins. So I think at the end of the day, all these things are trade-offs that the company is actually making. It's something to pay attention to, but it's actually nothing too scary over here. Now, on top of that, I think the real concern that some people have has to do with the increasing delinquency ratio for the 15 to 90 day NPLs, the non-performing loans. Now, to me, if you take a look at this actually inflected down over the last 2 quarters. And in the 90 days non-performing loans, that has actually just started to inflect downwards. So like I said, this is definitely a risk factor that we have to pay attention to, especially because they're serving in a particular market where I would say that the type of customers that they're serving isn't the highest quality. So there's definitely some cause for concern over there, and if people are worried about Nubank because of this, I can understand why. But if you listen to their recent earnings call, Nubank actually explained why this isn't something that they're worried about, because they actually told us that the 15 to 90 day non-performing loan is a leading indicator for the 90 plus day non-performing loan. So because of that, you can see the 15 to 19 day ratio is coming down, and because of that, over time, the 90 plus day NPL will start to come down in tandem. Now, moving on from this to understand more about their underwriting process, you can see that in every single credit box, Nubank's underwriting is outperforming what the market is doing, except for the 701 to 1000 credit score range, where they tend to match the market rates of around 0.06%. Now, why am I pointing this out? Because I actually think it's quite interesting. If you overlap these two pieces of data, what you can see is that as they are consistently having better underwriting than the market since 2023, what you have noticed over here also is that they have slowed down the pace of increasing delinquencies. And so what they're telling us is actually true, right? They really do have a superior underwriting to the market. And so because of that, they're slowly getting the delinquencies under control, right? At the end of the day, you have to understand that you're talking about millions and millions of people. And it's not just, a flip of the switch and you can just collapse the level of delinquencies. That has to happen over time. And that is exactly what we're seeing with them over here. So if all these things are actually going for the company, why in the world is it down 39%? Now, a lot of this, if you have followed the news, has to do with the Brazilian economy. Now, in Brazil, I think inflation seems to be coming back, interest rates are rising, and growth has been slowing down. So all of these combined together has made investors a little bit concerned in the short to medium term, because these are factors that can affect consumer spending as well as their ability to repay loans. Now, you combine that with the high non-performing loan ratios scenarios that we have just spoken about earlier, you can see why people are concerned about the future of Nubank, right? But I think in general, this sell-off is, safe to say it's due to macro conditions rather than any fundamental weakness in the company. So you can see from this graph over here, the dark blue region basically shows the forecasted GDP per capita of Brazil. And so despite some moderation in growth, which I'm going to, highlight to you over here, you can see the slope of the curve here is slightly less steep, but it actually re-accelerates in the back half of 2025 going into 2026. So this is not something I'm actually too worried about. Now, when we talk about inflation, yes, I think if you look at this graph, it looks bad. Inflation has climbed from 3.7% back in April of 2024 all the way up to 5% in February of 2025. However, I want to give us some context in terms of this, rise in inflation. If you zoom out and take a look at a bigger perspective since 2021, you can actually see that, this actually isn't out of the ordinary, right? Brazil's inflation has always been a little bit volatile, and they've seen a drop in inflation and then a rise, and then the inflation tends to drop again. And so if you look at the forecasted data, the same drop that we have seen happen sometime in the middle of 2023, and then we've seen this drop in inflation in the middle of 2024. We're again expected to see this towards the back half of 2025. So you put these two pieces of data together, back half of 2025, increasing GDP per capita, back half of 2025, lowering inflation rate. And so then it takes us to the last concern, interest rates, right? So naturally, as we have seen with the US, with higher inflations, what the central banks tend to do is that they increase interest rates to combat inflation. And so Brazil is no different over here, right? We have seen interest rates climb from around 10.5, 11% all the way up to 14% in the last couple of months. So this again is expected to decline together with inflation in the second half of 2025, and that is shown by the grey line over here, which means that if you believe that Nubank is able to ride through all of this volatility, then there is definitely upside in the business as interest rates and inflation comes down and as GDP continues to expand. And I think in the podcast that I was listening to over here, David Velez really puts it nicely. He says that, Nubank is a company that has been through an 8% drop in GDP in a year, the worst recession in over 100 years in Brazil, impeachment of a president, scandals and corruption, and each and every time Nubank has executed faster than the competitors every time they come out of a crisis. And so because of that, that actually helps them to gain market share, and this time will not be any different. So honestly, this is exactly what I've been hoping to hear for SOFI's tech platform, because if they are that good, if they're so much better than their competitors, then they should out-execute everyone as we come out of the fintech winter, which we are not seeing with SOFI's tech platform yet, which is why I was annoyed. Of course, things have changed over the last couple of weeks. That's something I'm going to be talking about in my next video, so stay tuned for that. But when it comes to Nubank in particular, I think Nubank has proven over the last 11 years that they can execute, and this time will not be any different. So when it comes to valuation on a trailing PE basis, Nubank is currently trading at around a 28 times PE. Now, they are cheaper than both Robinhood and SOFI, but again, like I said, this is reflective of the economy that they are in more than any kind of fundamental weakness around the company. Because if you look at the net income that Nubank generated in the last year, Nubank has been net income positive for a longer period than both Robinhood and SOFI, and in 2024 they actually generated a net income of around $1.97 billion compared to SOFI's around slightly less than $500 million in 2024. Now, when we talk about net income growth, you can see over here on a year-over-year basis, it's a little bit hard to project out the percentage number because the year-over-year percentage growth is coming down as the actual dollar amount of net income increases. And so we want to see where this level out and what is the kind of growth rate that they can maintain over the long run. And then from there on, it'll be easier to project out. But in terms of net margins, I wouldn't be surprised to see this at least eventually reaching the low 20% range, because that is where I believe SOFI has their long-term net margins as well. But again, this could very well be a conservative estimate because we have just gone through all the different aspects of the company, how they are a highly efficient company with superior unit economics compared to some of the other fintechs out there. And so because of that, I wouldn't be surprised to see their net income eventually grow to closer to the 30 30% range, right? But I think that is something that is down the line and something that we'll have to adjust our valuations as we understand more and more about the company. Now, their EPS, their earnings per share, basically came in at 40 cents in 2024. This is expected to grow by around 30% to 52 cents by the end of 2025. Now, what this means with a 28 times PE, this actually means that they're trading at around 0.9 times PEG. Now, if you compare that with SOFI, who is trading at a 34 times PE, but with an EPS growth of over 80% in 2025, then SOFI might seem slightly cheaper at a 0.43 PEG. Now, when it comes to their revenue has been growing at a 61% CAGR over the last 4 years, from $1.6 billion in 2021 all the way to $11 billion in 2024. So on a price to sales basis, they're trading at a 10 times price to sales. On the surface, that may seem like a very rich valuation if you are just looking at it on a very absolute basis. But if you compare that with SOFI, who grew revenues from $977 million in 21 all the way to $2.67 billion in 2024, that represents around a 30% CAGR. So they are growing at around half the pace of Nubank, and in terms of their price to sales ratio, they are trading at around 5 times price to sales. So because of that, I think you would say that it's a pretty fair valuation, and I think that's what we have over here, right? For the amount of growth that they are putting up relative to the market, objectively, yes, it's slightly on the expensive side, but after dropping so much with all the expansion plans that they have, I do think that they are more than fairly valued at this point in time. And I think the question for investors wanting to open a position in this company is whether or not you believe this level of growth can be maintained, and whether or not you actually believe that the moat of the company, which is their superior unit economics, can scale as they go into the different geographies. Now, I didn't really want to use the forward PE over here in this analysis, because while I do think a forward PE is a good measure for companies, especially ones that are in a stable macro environment, especially for companies with slightly more predictable earnings. However, in this case, I think with the uncertainty around the Brazilian economy, that may actually shift their EPS growth in 2025. And so how that would affect forward PE is really anyone's guess at this point in time, and that may not be a super accurate measure. So because of that, we're just sticking to price to earnings, PEG ratio, as well as price to sales. Now, in general, I do think that both Nubank and SOFI are fantastic companies, and I actually own both companies. But if you're talking purely on the basis of business fundamentals, then Nubank would definitely have the better unit economics. They actually do have better fundamentals than SOFI. But because of that, their valuation is slightly richer than SOFI, although still, at least in my opinion, fairly valued. Now, I think a lot of the differences that we see in these two companies in terms of business fundamentals is also a bit hard to qualify, because yes, Nubank has a superior unit economics, but like I've mentioned earlier, these two companies, when you're comparing them, they're not, in a sense, apples to apples comparison, because they're operating in totally different geographies with different cost structures and different kind of clientele. And I think whether or not you actually prefer Nubank over SOFI as an investment really depends on which side of the fence you fall on. Because if you are the kind of investor who thinks that profit is profit, it doesn't matter which country the profit is made, as long as you can convert it back to a US dollar basis and you can see it growing, you feel safe with these kind of businesses, then because of the superior unit economics, you may think that Nubank deserves to be trading at this premium, and because of that, you may think that they're fairly valued at where they are today. However, if you fall onto the other side of the fence, which means that you actually do think that yes, while you acknowledge the better unit economics, you acknowledge the higher profit margins and things like that, you're also wary that they're operating in a non-US country, and because of that, you do think that they don't deserve a premium because of all the risk factors that are involved when it comes to the possibility of default and just the general quality of the customer that they go after. And because of and if that is your concern, then perhaps, like I said, you don't think they deserve to be trading at such a premium over companies like SOFI. So personally, for me, I do see this as a safe way of tapping into the markets outside of the US and hedging my US positions. And for my risk profile, I'm happy to be owning shares of the companies. Now, in terms of options, I definitely would not touch any short to medium term options. So I do not even have 2026 options on Nubank, because you really don't know what's going to happen in the next year or so. I do have a small portion of 2027 calls at around $17, and that's about it. Majority of my position is in shares, and so because of that, I have the ability to hold for the long run. Now, at this point in time, I do want to say thank you for watching all the way to the end of the video. Now, like I said earlier on, because of my dummy batteries failing on me, I'm not able to do a live stream these couple of weeks, but at the same time I'm watching back some of my live streams and want to give it a bit of a better structure so that it's easier for you to follow, so that I can find a different dimension or a different way to add value to the community apart from just a typical market open. So if you do have anything that you would like to see me cover in a live stream on a daily or at least every other daily kind of basis, do let me know down in the comments below, and I'll see you in the next one.